Ladies and gentlemen, good day and welcome to Q1 FY23 earnings conference call of KEC International Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vimal Kejriwal, Managing Director and CEO of KEC International. Thank you, and over to you, Mr. Kejriwal.
Thank you, Neera. Good morning. I welcome you all to the Q1 earnings call of KEC. I hope that you and your family are safe and healthy. Let me start with an update on the overall performance for the quarter and thereafter talk about each of the respective businesses. We have achieved a revenues of 3,318 crores for the quarter with a robust consolidated growth of 31% and a standalone growth of 22% vis-a-vis Q1 last year. The growth has been delivered by good performances in most of our businesses such as T&D, civil, railways, oil and gas, and cables. We have delivered EBITDA margins of 8.2% at the standalone level and 5.1% at the Concall level for the quarter. The Concall margins have been impacted primarily due to the elevated commodity prices and logistic costs and SAE Brazil performance. While we have started witnessing softening of commodity prices in the later half of Q1 FY23, most of the costs during the quarters have been committed at the levels of Q4 FY22. We have delivered a PBT margin of 4.8% and a PAT margin of 3.5% at the standalone level. Our Concall PBT margin stands at 1.1% and PAT margin at 0.9%. Our YTD order intake stands at 3,472 crores, including the recently released orders of 1,233 crores. The largest contributors in the order intake have been our civil and T&D businesses, followed by railways and cables. We have a well-diversified and strong order book of 23,720 crores as on 30th June 22. Additionally, we have large L1 positions of over 8,000 crores, diversified across businesses. With this, our order book plus L1 position stands at a record level of over rupees 30,000 crores. Tenders under evaluation and in the pipeline to be quoted in the next couple of months stands at over 1,10,000 crores. Our net debt as on 30th June 22 stands at 3,418 crores. The debt level has increased during the quarter owing to loss and elevated borrowings in SAE Brazil and a few orders in standalone where the dependency component is much higher and the payments would come towards the end of the order. Our interest cost at the standalone level stands at 2.6% for the quarter as a percentage of sales, largely in line with last year. Higher debt level and increasing interest rates in SAE Brazil have increased our interest cost at the Concall level, which stands at 3% for the quarter as a percentage of sales. Now we talk about the specific businesses. Our T&D business has achieved revenues of 1,645 crores with a strong growth of 17% vis-a-vis Q1 last year. The growth has been delivered by robust execution across India, Americas, SAARC, Africa, and Middle East. In Brazil, I am pleased to share that we have physically completed 4 EPC projects this year. 3 of them have already been energized, and the 4th one is awaiting energization by the client. We have also secured a bonus for timely completion of one of the projects. With this, we now have 1 EPC project under execution, which is scheduled for completion by end of Q3. We are confident of a gradual revival in the performance of Brazil in H2. In terms of order intake, the T&D business has secured new orders of over 1,200 crores for T&D and cabling projects across India, Middle East, and Americas. I am pleased to share that we have secured a prestigious order for the building of India's first 765 kV digital substation from Power Grid. The orders in India have strengthened our order book from PGCL and state utilities and expanded our private clientele. With the cabling order in Middle East, we have reinforced our presence in the international cabling solutions segment. We have also significantly enhanced our order book in Americas to rupees 1,138 crores for supply of towers, hardware, and poles, a growth of 18% vis-a-vis last year. With this, we now have a complete loading of the SAE Mexico factory for the balance quarters of this year. The overall tender pipeline in T&D continues to be strong both in domestic and international markets. Additionally, the business has a large L1 pipeline of over rupees 2,000 crores, contributed equally by the domestic and international markets. Our railway business has clocked a revenue of over 700 crores for the quarter with a stellar growth of 19% vis-a-vis Q1 last year. The business delivered a double-digit margin despite a challenging environment. The business has also secured orders of over rupees 400 crores, comprising of orders in conventional OHE as well as orders in new areas of speed upgradation and OHE for metro. We continue to focus on opportunities in emerging areas such as TCAS, train collision avoidance system under Kavach, which aims to enhance safety of Indian Railways with world-class technology. The railway tender pipeline continues to remain healthy across conventional, technologically enabled emerging areas as well as international opportunities. We are witnessing a gradual pickup in the tendering activities and are confident of securing a large share of orders in the coming months. With the continued thrust on execution, strong tender pipeline, and an order book plus L1 of over rupees 6,500 crores, we remain confident that railways will continue to grow. Our civil business has delivered an exemplary performance with revenues of over 600 crores for the quarter, with an impressive growth of 2 times vis-a-vis Q1 last year. The business continues to deliver consistently on the order intake front and has secured orders of over rupees 1,200 crores across industrial, residential, hydrocarbon, defense, and data center segments. Additionally, the business also has a large L1 pipeline across water pipelines, industrial, and residential segments. The uptick in order intake has significantly enhanced the order book plus L1 to an all-time high of over rupees 10,000 crores, comprising of turnkey EPC projects across segments from marquee clients. The government spending across segments continues to lead the way for growth, with a special emphasis on urban infrastructure and water pipelines. We are also witnessing a gradual revival in the private capex in the industrial and the realty sector. We are confident that this business will be the key growth driver for us going forward. In oil and gas pipelines, the business has delivered revenues of rupees 92 crores and secured an order of 105 crores during the quarter. With concerted efforts, the team has successfully achieved completion of a targeted pipeline laying project, which will significantly enhance our PQs and pave way for us to secure similar orders in the future. The business has a strong order book plus L1 of over rupees 1,000 crores, comprising government and private players. We are confident that this business will become a significant part of KEC's overall business portfolio in the coming years, both in India as well as overseas. Our cable business has grown by 26% vis-a-vis Q1 last year and achieved revenues of rupees 419 crores. During the quarter, we have formally inaugurated our state-of-the-art railway products manufacturing facility. Over the last couple of years, we have developed and launched new products such as signaling cables and jumper topper wires through this facility, and have also ramped up capacity to manufacture contact and catenary conductors. This strategy of backward integration is helping us make cables business a strategic enabler for our railways business and at the same time address the growing demand for railway products in the external market. The business is also progressing well with the development of additional new products. It has received approvals for a few products during the quarter and is on track to commercialize them this year. Overall, we are pleased with our revenue growth and order intake despite significant challenges. We are making good progress in deploying several mechanization, automation, and utilization initiatives across projects to improve productivity and the quality of execution. We have started seeing softening in the commodity prices of late and have commenced execution of projects which had been secured on a higher commodity and logistics costs. On a concluding note, I would like to convey that the traction order intake, record order book plus L1 of over rupees 30,000 crores, and a strong tender pipeline, we are confident of delivering continued good growth in the balance 3 quarters of the financial year. Thank you very much. I am now open to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Rami Swaminathan from Spark Capital. Please go ahead.
We would have seen a healthy order inflow growth of around 7-8% CAGR. Just wanted to check with you. So basically, over the next 2 to 3 years, what kind of order inflow growth that we can think about, and which are the segments which will drive? So will it be basically the civil and railways which will be the key drivers? And if you can give the thought process on power T&D spends also would be great, sir.
Ravi, morning. So, Ravi, on the order intake side, I think our targets are around a 15 to 20% growth year on year for the next few years. That's on the overall numbers.
Okay.
The drivers, the way it is happening today is going to be, number one would be civil, number two would be T&D, okay, and three would also be oil and gas, but the base is small. So the percentage increase may be significantly higher. Volume-wise, it may not be that much. Coming back to your question on T&D, we already announced a couple of orders from Power Grid in the last few lists. We are L1 in some more of them. So Power Grid is slowly coming back into the fray as a larger client in India. And I think yesterday or day before we saw a news item where 22,000 crores of funding for the Leh-Ladakh transmission line is under process or something. Those orders, those tenders should come out quickly as per our discussions with PGCIL. Also, we expect that the decision on the GIB should also come in the near future, which would again sort of release that entire green energy corridor orders, which are, the TBCB bidding, which is on hold. That should get released in I think, the very close future. So I think on the India side, we are pretty hopeful of a large tender pipeline and order intake in the coming quarters. Internationally, I think the major orders or tenders are coming in from Middle East, driven by the oil price of $100 plus. Two countries stand out, which is Abu Dhabi and Saudi. And the other country where we see our orders coming in is Bangladesh. So these are the areas where, and Americas. Both North America and South America, we are seeing. I already mentioned that our Mexico plant is full. Brazil also, we have got a lot of orders now on the tower supply and hardware, and we are expecting some more orders.
Got it, sir. And my second question is with respect to the losses in SAE. So what was the absolute loss at a PAT level in SAE or at an EBITDA level this quarter? And what is going to be
Yeah. So at PBT level, it was around 100 crores.
100 crores.
Yeah. And EBITDA was around 70.
Okay, sir. At an EBITDA, it's around 70. And how do you see this improving? Do you see this improving? And what is the key reason behind it? Is because of just currency and the combination of execution or any other factor related to that?
So one reason when you see the difference between EBITDA and PBT is the interest cost. There has been a loss funding loans, and also the interest cost there has gone up from 7-8% to 17-18%. Okay. So one reason has been the highly elevated interest cost, I'll say. And the second has been the delays which we are having in project completion and contractual issues on COVID and all that. So our view, Ravi, is that by end of this quarter or max maybe a month behind that, we will finish all our EPC projects. Okay. We have got large claims which are getting under discussion, and I think by Q2 or max Q3, those claims will also get settled. And by that time, we will be completely out of our losses on our EPC projects in Brazil. So Q2 maybe a little bit spillover in Q3. I'm not sure. We'll see if we can. The claims can be closed in Q2. Then the whole piece should get closed in Q2. If not, there could be a minor spillover in Q3.
Got it, sir. Got it. And third question is with respect to working capital. So basically, from 130, 135 days range, this quarter it has jumped up to around 150. So you had mentioned railways in the PPT. So is it like, so the mix itself is like that, or some payment delays which will get restored over the next 2 to 3 quarters?
So Ravi, there are a few reasons we mentioned railways, but see, one is starting with the fact that we grew by 31%. So the fact that we are growing by 31% means your absolute working capital will definitely go up. So that's one reason. Second is we have been losing money in SAE Brazil. That requires some funding to be done. So that's the second piece. And third piece is what we are talking about is we have got a few projects both in railways as well as in T&D where a significant portion is back-ended, especially on price variation and some other items. So those projects are slowly coming to a close. So we do expect that by Q2 or Q3, that funding will get released. So we expect that by Q3 onwards, we'll start seeing a reasonably good improvement in the working capital. Q2 may still remain at stretched levels, maybe these levels, maybe it may come down a little bit. I honestly difficult to predict. But Q3 onwards, I think we are very confident that the working capital will start showing improvement.
Got it, sir. And my question is, yeah.
I think there's a long queue if you don't mind.
Sure.
Thank you. The next question is from the line of Parishit Kandapal from HDFC Securities. Please go ahead.
Yeah, hi, Vimal sir. So my first question is on this increase in the debt. So that has been increasing and it's almost doubled from the levels of FY21 FIC from 3,200 crores to almost 6,000 crores now, including acceptances. So if you can, I remember in June 21 we had an analyst meet and you had highlighted that we have about 200 crores of capital employed in civil business and 1,200 in railway business, and total was about 1,450 crores was the total capital employed in these two businesses. So if you can just give a breakup of this debt levels, how it is split across businesses, T&D, civil, railways, and SAE, so that will be helpful for our understanding.
Parikshit, I don't have that breakup now. You can talk to Abhishek later on. But broadly, I can tell you that civil, we are pretty okay with our numbers in terms of debt and net working capital. Similarly, I think the problem is still lying with one is railways, as I mentioned, that couple of projects are on a different mode now. See, railways earlier always used to have BOP-based projects. Of late, I'll say a year and a half back, they shifted to, in a way, LSTK sort of what we call EPC, where payments are made on certain, achieving certain milestones, etc., which is a new concept both for our railway team as well as for the railway team itself, for the railway client also. So that has taken some time for people to understand how to implement and close it. So that is happening. Then on the T&D side, we have got some very large profitable projects where contractually all the price variations are payable at the end of the year. And you know that last 1 year there have been large price increases. So there are substantial amounts which are to be received from the clients, which we will start getting now that the projects are going towards an end. So to me, and also obviously SA losses were there. So these were the reasons why the numbers have gone up. But as I said earlier to Ravi, I think we are pretty okay. We are pretty confident that the numbers will start improving next quarter onwards.
Because sir, if I see last 3 years cash profit, if I add up, it's about 2,000 crores of cash profit you have generated. And if I see the working capital, the growth in the revenues, the working capital should have increased by 800 to 900 crores. You have done some capex of 700-800 crores over the last 3 years, but your debt has gone up by 2,700 crores. So I'm not able to reconcile why there is such a huge debt built up, because typically in EPC companies we don't see debt coming down. Once debt reaches these levels, we've hardly seen this diversion happening. So how do you see the 6,000 number panning out over the year end, by this year end, because you said a significant part of that is also into SAE. So if you can quantify at least what is the debt sitting in SAE and how will be the year end looking in terms of overall debt?
So Parikshit, one is I don't agree with you that once it goes up, doesn't come down. If you look at our history also, our debt had been coming down consistently except when the COVID hit us. Okay. So that's, I think we are pretty confident between our teams that, debt will go back to our normalized levels. And we have been talking about, the debt minus acceptance is going back to 2,500, whether it will go down at Q4 or whenever it is, but the target is very clear. And I think we are also doing a lot of things on that front. Okay. So I think as a team, we are pretty confident on it. We are worried because, see, I'll tell you what has happened is we have got an Afghanistan issue. So we have got, net of 250 crores stuck there, which we were expecting that some part will start coming in. If it has not come in, but a lot of discussions with World Bank and ADB is going on. So maybe the money may come in Q2, maybe the money may come in Q3. Then what we talked about back-ended payments, those payments will start coming in Q3. So I think Q3 onwards, you'll definitely start seeing an improvement in the numbers.
And just last thing, sir, on SAE debt, how much is the debt and how much is the claims which you are looking to file? Because you did mention about some claims and realization of claims by Q3. So if you can just quantify these two numbers.
So the debt is around 400 crores there. Okay. And claims, very, very difficult to give numbers, but we have been talking about anything between 50 to 100 crores of claims coming in. But let's see what happens. Okay. Unfortunately, Brazil has got a very peculiar contractual system, and the president there has not declared COVID as a force majeure and all that. So all the contracts are, becoming pure commercial discussions. Okay. So let's see. I think, as I said earlier, that by end of Q2 or early Q3, the Brazil should be behind us.
So this 400 crores is built up only in this quarter or like last quarter? Because you said that there's been...
It's over a period. I think last 3-4 quarters it has built up. I think what has exacerbated the whole issue is the rise in the interest rate from 7-8% to 18-20%. Okay. So, the interest cost of 30 crores which has gone up there is partly because of the debt increase and partly because of the rate increase.
Sure, sir. Thank you. I'll join the queue.
Thank you, Parikshit.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Saumin Maheshwari from Edelweiss. Please go ahead.
Yeah, hello sir, good morning and thanks for the opportunity.
Good morning.
Sir, the first question is, now if you see the commodity prices have started receding and we also see the SAE levels maybe a quarter or 2, but that is likely to be behind us. So if you can just give us some sense of comfort on the margins trajectory going forward, not asking for any kind of a guidance over here, but some sort of semblance on the margins part really. That will be helpful.
So, Sonim, what is going to happen is that I still feel Q2 we may remain at the similar levels. I don't know whether plus or minus 10, 20, 30 basis points here or there. Although you didn't ask for a number, I'm giving you a number. Okay. But from Q3 onwards, definitely we will start seeing improvement in margins driven by three things. One is SAE numbers. Okay. We should not see any large loss or, even if there is something very nominal, but hopefully there should not be much. Second is the commodity prices are coming down, so some of our fixed orders which are right now under execution and which may spill over to Q2, Q3, there the losses will come down. And the third one is that we have an order book plus L1 of 31,000 and many of the orders have now started executing. And these orders are taken at the current prices or in some cases even at the higher prices. Okay. So with a combination of all these three, we'll definitely see the Q3 margins going up. And so to me, I can see an upward trajectory from Q3, then still better in Q4. Okay. But that's the way we are looking at the margin trajectory. And also, as I was telling Parikshit earlier, that we do expect the working capital to start improving. So hopefully in Q3 onwards, we may start seeing some decline in the interest rates also. So from EBITDA to PBT, the differentials may start coming down. But it will also be driven by the growth factor, so the top line will also grow significantly.
So are you guys targeting double-digit margins by FY24?
100%.
So back to our 10% levels?
Yeah. No. We are clearly targeting to reach that. There is no question about it.
Fair enough. Sir, my second question is on the civil business. So we are ramping up quite nicely over there. How is the margin trajectory? Are we now kind of converging with some high single-digit margins, or where are we in civil actually?
So actually this quarter we were almost at double digit. Okay, almost at double digit. So I think it will take us a couple of more quarters. I think by the end of this year, we should be ending the year with around double-digit margins. Okay, the order intake is at a fairly good margin. Okay, so maybe next couple of quarters we will still try to consolidate and do it. But I think by next year onwards we should start showing double digit from Q1 onwards. That's the expectation. Okay.
So railways and civil are kind of double-digit margins because railways you are also doing double digits, right?
Railways right now is double digit. Okay, the issue what we are having in railways is that we are shifting to more technological on metros and other things. So some of them there is a learning curve. We expect to continue at double digit, but I don't see a major improvement or anything happening in the railway. I think our problem is not as much as EBITDA as PBT. Okay, we have seen blockage of working capital, etc. So we are in a way. Let me put it this way: in a way, we are going a little bit slow to till we consolidate and get all our monies out of railways and get our working capital back on track. But railways is also having decent margins, but the margins will go up in civil.
Fair enough, sir. Got it, and thank you so much. I wish you all the best.
Thanks, Varun. Thank you.
Thank you. Next question is from the line of Ashish Shah from Centrum Broking. Please go ahead.
Yeah. Good morning, sir. Right. So first question is on the, again, a little bit on the commodity side. So we were at a position in Q4 where certain of our orders, the implied commodity price was higher. Implied commodity price in the contract was far lower than the prevailing prices. So are we done with those contracts, or is that much of that pressure behind us, or there is still some to come on the commodity side?
So Ashish, there is definitely pressure to come, which is why we are talking about improving of margins from Q3 onwards and not Q2 onwards. Okay. There is still pressure to come. We are slowly executing all the orders. I think the good part of it is that with the commodity prices coming down, we have hedged a lot of our open exposures. Those exposures will get into revenues in hopefully in Q2 and maximum in Q3. So the open position on commodities has come down significantly. Most of it, whatever is hedgeable, we have hedged. Okay. There's some small quantum of hedging left out, which we are slowly doing it.
Okay. So secondly, I know you said you did explain a few things on the working capital side, but do you see any chance that, let's say, if it takes us a quarter or more for the working capital to come to reduce, it starts impacting our execution? We tend to slow down on the execution because the payments are taking longer. You see that sort of a scenario probably happening?
So I'll let Rajiv answer it. I have talked enough on working capital.
So I think Ashish, as Vimal rightly said, that some of the reasons he very much explained. We are not too much concerned on the working capital. We have adequately funded all the projects. So our view is that execution will not come under any pressure because there is an adequate amount of working capital which has been pumped in and which has been provided to all the projects, which is which will take care of their execution. And some of the things like which are projects having back-end payment and the price variation, which will start accruing to us towards the closure of the project. So all those monies will start coming to us. Already, in fact, there has been some improvement, but obviously, in quarter one, you should appreciate that there is a 30% growth in the business, so that has taken some additional working capital. But definitely, from Q3 onwards, Q2 also, there will be some improvement, but Q3 onwards, I expect that things will be more visible. There is one more aspect that you should look at, that last couple of years, our business in civil and railways grew quite well. And there, most of the projects are carrying the inverted duty structure. So what happens is that all my inputs were carrying 18% GST, whereas the output was only 12%. So that was adding a substantial amount to my tax balances. If you look at my balance sheet, there is a substantial increase over the last 2 years on the tax balances that has been added. So that has also taken a lot of working capital. Fortunately, on 18th of July, the Government of India has corrected that anomaly, and they have increased the GST rates from 12% to 18%. So that will be a very positive trigger for our working capital and for most of the EPC companies, for that matter, which are doing railway projects and metro projects, government tenders and all that. So there itself, I expect the release of working capital will be roughly about 250 to 300 crore rupees per year. So next 2 years, probably whatever we have accumulated, almost 500 crore rupees on account of the inverted duty structure on the tax balances, that will get released. So that's a very positive thing. So and last 1 year, 1.5 years, because of the elevated price level, all the tenders where we have the price variation also, which are funded by multilateral banks, there the clause is that price variation will be settled towards the end of the project. So we have accumulated a large amount of price variation in those projects that will get settled. So now with the projects getting to a closure from Q3, Q4 onwards, then probably we will start realizing those payments also. So we know there is some bit of a elevated working capital that we are running, but we are quite sure that amount is going to be recovered shortly. So that's the reason we are not worried on that account.
Got it, sir. Thank you very much for your response. Thank you.
Thank you. Next question is from the line of Bhumika Nair from DAM Capital Advisors. Please go ahead.
Yes, sir. Good morning, sir.
Good morning, Bhumika.
I wanted to understand this working capital a little more. Sorry to harp about it. We've seen the debt go up in SA. So you said that, the losses will come down as these projects get completed into Q2, Q3. But, how will the debt reduce out there? And, with this reduction in India from both railways and these T&D projects which get completed and the variations come back, then how do we see the working capital days come down to what level? Because, we've seen over the last 2 to 3 years, the working capital days increasing from 120 to about 148 days. And intermittently, we even had something much lower than that. So where do we see this settling by the end of the year?
So, Bhumika, as far as SA is concerned, the debt will not come down immediately. Okay, I don't think if I gave that impression, it's my apologies, but I don't think we said that SA debt will come down because SA debt has gone up because of the loss funding. So as and when they start now making money and all that, slowly the debt will start coming down. Or I put in some more equity from India. Obviously, the arbitrage is very high because we are paying 18-20% interest there, and the costs here are 4 to 5%. But so SA debt will only start coming down when they start making money, or I remit more cash from here, equity from here. Okay. Overall, I think as Rajiv was talking earlier, we are very clearly, that our targets have always been 100 days. That's the way we have always been. Our aspiration target is always that how do we reach 100 days. We are working on it. I think difficult to give a number, but I think maybe 10-15 days is what we should be looking at by the end of the year. So maybe 130, 135 is something which we should look at reaching by the end of the year. And as Rajiv said, which I had missed out earlier, was GST could be one thing at 250 crores or something should come back from that. Many of our railway projects where there is a EPC project where the payments were milestone linked and a little bit back-ended, those are getting over. So large releases will happen from the railways, and some monies will come in from our transmission, and hopefully, I think Afghanistan, we are seeing a lot of discussions happening between ADB, World Bank. In fact, yesterday also I saw UNDP Afghan tweet saying that we are working with the Afghan government on restarting our projects, etc. So if that starts, then that could be an additional bonus for us in terms of reduction of the debt. Are we worried? Yes, we are worried slightly. We did not want it to go ahead, but I don't think it's something which is impacting the operations or anything else. I hope I have answered your question.
Yes, sir. Yes, sir. So just on SA, basically what we're saying is while the EBITDA loss might come off, but until and unless the internal accruals help in terms of paying out debt or we remit money, the PBT loss because of the interest cost might continue. Would that be the fair understanding?
I'm not sure about it. See, what is happening is that the EPC revenues will come to an end by this quarter, Q2, sorry. Maybe a little bit may spill over to Q3, but I think hopefully by Q2 the projects will all get over. Then what will remain there is going to be the revenues from our. Right now we have not taken any EPC orders, and we are not taking anything in the very near future at least. Okay. So our order book there is a large order book, and we are expecting some more orders now in SAE in terms of tower supplies and hardware. So it would depend upon how the steel and zinc prices, behave. Like zinc has now come down significantly. So it would depend upon the profitability of these orders. Some of these orders are pretty decent and are at the current prices. Current interest costs are baked in. So if the commodity prices remain at the current levels, maybe we may turn even PBT positive also. Okay. So that's the way I look at it. I'll say a borderline case.
Got it. So my second question is on the railways business. We've been fairly, because of the elongated, payment cycle and receivable cycle, etc. We've been quite, cautious on the order inflows per se because, we've come off to, less than 2,000 crores kind of a number. Now, what are we seeing this kind of as we move ahead in terms of order inflows and likely growth? Because so far the order book has been healthy and we've been able to manage the revenues, etc. But as we move ahead, what are we seeing out there?
So, Bhumika, railway business is changing in many aspects. Okay. One is the way we have been bidding. So we were earlier doing only electrification, then we got into civil, then we got into signaling and telecommunication. Now today, if I want to divide my railway business, there are three components. One is on the metro side, where we are doing signaling, telecommunication, OHE. We announced a few orders on the metro segment in the railway business. The second piece is on the railway on the technology side, as we call it, which is on Kavach, which is also on speed upgradation, which is on signaling and telecommunication. That is becoming a large part for us. Third piece is that what we are now seeing is, and we were actually apprehensive earlier that, all the tendering was moving in from the PSUs into the zonal railways, and we thought that zonal railways are, prone to break down the tenders into 50 crore, 100 crore. What we have seen is actually the reverse of it. In fact, in August, we have to quote two tenders which are close to 1,000 crores from the zonal railways. And what they have done is that they have started combining the tenders of, composite with track laying and electrification and signaling and all that, which is where our core strength is. Okay. If it was a pure and plain civil tender, then all the road players used to come and bid. Now that we have clearly seen stopping. Second piece is that with the bid bonds and all coming back, the competitiveness is sort of a number of players have come down and all that. So I think it will slowly, we will start seeing the railway order book building up in various places. We are very conscious of the working capital, and I'll not say working capital is stuck because of slow payment of the railways. I don't think that is the right statement which I will make. It's stuck up because of the nature of the contracting. And I think the railways have also realized it. So some of the newer contracts, they have changed the payment terms. EPCs of earlier EPC payment terms are very different from the current EPC payment terms. So we are waiting and looking at each of the tender and then quoting. So I am very hopeful that our railway order book will increase. In fact, we are L1 in one of the international orders already. Hopefully, by the end of this month, that should get converted into our first international order also.
Okay. Great, sir. Wish you all the best. I'll come back in the question queue. Thank you.
Thanks, Bhumika. Thank you.
Thank you. Next question is from the line of Shalini from DSP Mutual Fund. Please go ahead.
Sorry, it's the same thing, stuck record. In terms of the railway, when is the project going to be completed? Where there is an elongated working capital cycle, and is that in Q2 or Q3? I just missed that. And second thing is more, given the fact that your credit ratings are very important to maintain a low interest cost and keep your ratings at least AA minus. Have you, could you tell us in terms of your conversations with rating agencies, because a lot of the triggers that they've put in seems to have been, your numbers are worse off than the triggers. So that's a second question that I had. Thank you.
So one thing is that the railway project is expected to be completed in Q3. Okay. However, we do expect that some of the milestones will be met earlier. So part of the money should start coming in Q2 and the balance should come in Q3. As far as the rating agencies are concerned, I don't know what they will do, what they have to do, but we recently had a review of our ratings and they have been affirmed at the same level. I think, Raju, recently?
Yeah. In a couple of months.
Yeah. So I don't know. I don't think ratings are at a risk today. So one minute, Raju wants to add something.
Yeah. So basically, on the rating agencies, so we had a review post of last financial year's result. So rating agencies have taken the case to their audit committee, to their rating committee, but they did raise some issue on the elevated working capital, but we have explained them that what are the reasons for this increase and how we are taking the steps and correcting it. So based on that, they were seems to be satisfied, and that is how they have reaffirmed the rating. Okay. Both ICRA and other agencies who have been rating us, they have all reaffirmed the ratings at the current level.
Thanks a lot, Rajiv, and wish you the best.
Thank you.
Thank you. Next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. I just have one question pending on the railway segment of the business. If you look at the backlog today, we have close to 3,800 crores of order book, and we are expecting to execute almost 3,500 odd crores this year. So coming back to the question in terms of growth visibility for the railway portfolio, if you can help us quantify it, as in you did mention 1,000 crores kind of orders coming through. But how should we look at growth in this segment in the next 2 years? Do we see some bit of consolidation in this business because of slowing order book and increasing competitive pressures?
So, Renu, there is definitely some consolidation happening in this business because there has been a change in the nature of business from, as I said earlier, from RVNL and, rights and all going back to the zonal railways, etc. So there was some consolidation. Also, we were seeing some change in track by the government, and right now they have started focusing on speed accreditation. Then they went into safety, etc. So there has been some delays in the ordering also. But now I think all those things are behind us, and we are seeing large number of tenders coming up. Just to give you some sort of numbers, right now we have got around 5,000 crores of tenders which we have quoted in the railways.
Mm-hmm.
Okay, which are awaiting an opening. So if you take let's say a success rate of 20%, that could give you 1,000 crore. We have another 12,000 crores of tenders to be quoted in the next couple of, I'll say a month or so. Okay, so the pipeline, if you add the two, we are talking about almost 17,000 crores of tenders to be decided or to be quoted now or in the next couple of months. So I think we are pretty okay. Also, as I was mentioning earlier, that we should be getting our first international order this month, hopefully. We are L1 already. And we are also looking at that opportunity outside where there are large number of tenders, most of which are not considered in the figures which I told you. Okay. So I think railways right now, it's under consolidation phase. I don't see a major growth happening this year in railways in terms of last year. Okay. But next year, on the back of the orders which we will now get, we will definitely see a growth happening.
Sure. And lastly, if you look at the metro part of the portfolio, if you can help us in terms of the update on the various metro projects that you were executing, and there were certain pending cost escalations in a couple of them. So where are we in terms of realizing those cost escalations, and by when should we expect overall margins in the metro portfolio to be realized?
So we were doing 7 metro civil projects, okay?
Mm-hmm.
2 in Chennai, 2 in DMRC, 2 in Kochi, and 1 for RRTS. Okay. Of that, the first one in Kochi has already been commissioned. It's been commercially commissioned also now. Okay.
Mm-hmm.
RRTS, I think it should get completed anytime, maybe a month or 2 or something. But the viaduct is already ready, handed over to the other party to lay the lines, etc. Kochi, Chennai are going on very fast. One of them is in very advanced stage. It will take time, but it's reasonably okay. Second one just started a few months back. So DMRC, one of the projects is going on very well. Second one is stuck in approvals, and maybe a part of it we may surrender also because the Supreme Court, the Green Committee has not yet cleared the full route, etc. But I think overall we are pretty okay with what we are seeing in terms of margins, etc. in the metro sector. As far as claims and all are concerned, so there are 2 parts to it. One is claims which arise because of various costs and other things and all design changes. Second one is on account of scope changes and all that. So part of that are getting accounted and closed, and we are getting payment of it. Part of it which are in the nature of claim, like let's say idling claim. You had an NGT issue, or you have, let's say, you remember Supreme Court saying that you can't work in NCR in November, December because of smog and all that. Those get into claims which get settled at the end of the project. Okay, so those claims will now get settled one by one. But the normal claims on account of change in scope, change in design, etc., are an ongoing process where we keep on submitting and they keep on getting settled.
Got it. Sure. Thanks much, sir, and all the best.
Thank you, Renu.
Thank you. Next question is from the line of Priyankar Biswas from Nomura. Please go ahead.
Yeah, good morning, sir.
Morning, Priyankar.
My first question is, so you told that railways are already at double digits EBITDA margins, and civil is quite close to that as well. So by implication, it means that the T&D margins, which earlier used to be like 10% or somewhere higher than that, seems to be in very low single digits. So do we have? So there seems to be a lot of legacy contracts here. So what is the status about those, and can you give us some type of a idea that when are we expected to complete these legacies? And let's say when the T&D margins can go back to somewhere around 10.5 that they used to be.
So Priyankar, your calculations are pretty okay. I think, and I think a large part of the issues on the T&D margins has been on the commodity side, okay, and also on account of SAE, because we have to add all the three of them. What we have international portfolio, we have an India portfolio, and we have the SAE portfolio, okay. So SAE has been losing money, in which you are talking about it. International also has not been doing very well because most of the contracts in international were fixed price, okay. They are now slowly getting over. So as I mentioned earlier, I think by Q3 we will start seeing changes. In fact, if you look at our order intake for the year, a large part has come from international T&D, which are at current prices or maybe even at a higher than current prices. So now that the execution of those projects are starting, we will start seeing an uptick in the T&D revenues, margins from Q3 onwards. We still have some legacy projects from Power Grid, and if you remember, we had an old SL project also which was taken over by Adani. So some of those projects are at fixed price, and the impact of that you can see in the margins. So that's why our Q1 margins are low, and Q2 also we are not predicting an increase in the margins. So hopefully by Q2, and if not part fully, but then at least the balance should probably get knocked off in Q3. That's the way I look at it.
So probably, let's say in a 4Q or maybe 1Q FY24, so would it be fair to say that the T&D at least can again go back to double digits? So I'm speaking of T&D individually only.
So Priyankar, I already stuck my neck out and said that next year we should start getting back to double-digit margin for the company as a whole. T&D this quarter is 45% of my revenue. So if T&D doesn't reach double digit, I cannot reach double digit. So the assumption that is that it will start reaching double digit or very close to double digit and backed by civil and railways. We should be, that was the basic assumption when we said that we should hopefully reach double digit.
Okay. And so one more thing is like I see that in this quarter, the other expenses as a portion of the revenues are quite high, like 10% plus. So we hadn't seen that sort of a high other expenses for quite several quarters. So what has actually led to this sudden sharp rise in other expenses? So I understand the commodity price, the gross margin.
There are two items, Priyankar, there mainly. One is the sharp increase in freight cost. Okay. So many of our projects in Africa, Saudi, etc., we have seen freights going up by 3 times or 4 times. So the freight is one of the large elements why that has basically gone up. Yeah. So almost 45 crores is the impact of the freight going up. The second is that this year this quarter we did not have anything. Forex was sort of neutral. Okay. Normally what happens is that you have a Forex income and all that happening, which neutralizes, which is set off against other costs under the head of other expenses. Okay. So Forex income this year is virtually zero or something like that, nominal. So because of that, the other expenses are low.
Priyanka, we are unable to hear you.
Yes, I can hear you. Hello. Hello.
We move to the next participant. The next question is from the line of Rishabh Dugar from CD Research. Please go ahead.
Good morning. So what sort of efforts are being undertaken by you to bring down your debtor days?
Participants, please stay connected. The line for the management dropped. Ladies and gentlemen, we have the line for the management reconnected.
Rishabh, I hope we have answered your question.
Sir, sorry, that was Priyanka. We have Rishabh.
Sorry.
Yeah. Okay. So what sort of efforts are being undertaken by you to bring down your debtor days?
I think I think Rajiv explained it. Rajiv, you want to once again explain what you said about how the debt will come down?
So basically, Rishabh, as I explained earlier, that there are few contracts where there is a large price variation because last 2 years that commodities have remained at an elevated level. So that has entitled us to get huge price variation in few contracts. And unfortunately, those funded by the multilateral, that there is a clause in the contract that those price variation will be settled towards the end of the contract. So those things are will be settled towards the end of the contract when we finish. Some of them are closing in Q3 and Q4, so we are likely to receive that money. So that will help us bringing down the DSO days. Another important factor that you are aware that Afghan exposure, we have about 250 odd crore net exposure in Afghan, and due to the force majeure issues, we are not able to recover that money. But our dialogue with the funding agencies, World Bank and ADB, are regularly going on. And in fact, they are going to start the project maybe in Q3 or maybe in Q4. We don't know. We can't really give you the timeline, but they are very clear that these projects are very important and they want to finish these projects. So once we restart those projects, so there is a visibility to recover the Afghan exposure also. So that will help us to bring down the DSO days. The third thing which is there, Vimal also explained quite a few times, is that certain railway projects which are EPC in nature, which are very different from the BOQ type of projects where you can only bill to the client and recover the money only on completion of certain milestones, and those milestones are like quite big. It takes time to complete those milestones. So once those milestones get completed, so you are entitled to raise the billing and then realize the payment. So one of the large projects in railway electrification that we have been doing is likely to get completed in Q3. So that will also release large amount of money. So our expectation is that between Q3 and Q4, a lot of these DSO days will come down, because as we complete those projects, we will be able to recover the money.
Okay. So what sort of projects are more comfortable in taking? Are these the T&D projects or the railway or civil projects?
Rishabh, it is not the business-wise project. It is actually individual tender-wise. What are the payment terms? What are the conditions for payment, etc. Okay. So even in civil and all that, sometimes we get projects which are back-ended or linked to large milestones, etc. So it depends upon individual tender and project rather than, I'll say, classifying it under each business. But generally, we have seen that civil payment terms are better and cash flows are better if you execute the project well. Generally, I'm just making a general statement.
Okay. Thanks a lot.
Thanks, Rishabh.
Thank you. Next question is from the line of Swarnim Maheshwari from Edelweiss. Please go ahead.
Yes, sir. Some sense also of the total ordering opportunity at the moment that is being targeted.
So Swarnim, right now, if you look at our numbers, we have quoted around 27,000 crores of tenders, which are awaiting results. Okay, so that's one part of it. And our pipeline for the next 2-3 months is roughly around 80,000. So between the two of them put together, it's around 110,000 crores. Quoted and to be quoted.
Got it. Sir, this used to be about 50 to 60,000 crores about a year back or so. So I believe the big jump is actually coming from the civil. Is that a correct understanding?
Not exactly. Civil, I'll say, is roughly around 30,000 of it. Okay, but a large part is transmission. Okay, both one domestic and also international, especially on the MENA side. Okay, MENA is almost close to 20,000 crores right now out of this number.
Okay. And domestic?
That's a large portion. Domestic T&D, the numbers are very big. I don't know if you include Leh, Ladakh and all that, then we are talking about 35,000 crores. Okay, that number is included in this. There are a large number of tenders which are stuck on the GIB issue, which I think the expectation that will get resolved either way very quickly. Okay. If there is a problem, then my cabling business will do well. If they agree to lay transmission line, then the transmission will do well.
Right. Yeah, that's it from my side. Just wanted to understand that part. Thank you.
Thanks, Tony. Thank you.
Thank you. I now hand the conference over to Mr. Kejriwal for closing comments.
Thank you everyone for your continued interest. I think I can only add that we have got a large order book. The raw material prices and all are coming under control. So we will definitely start seeing changes happening, from Q3 onwards. Thank you so much. Thank you.
Thank you very much. On behalf of KEC International Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.